Right now, about 9% of all loans are being done as an ARM, an adjustable rate mortgage. It is a tremendous opportunity for some people, but it is not right for all. What is an ARM? Why do an ARM? And how do they work? They're starting to gain in popularity because the interest rates are a little bit lower, and that's a way to hedge. Now, why would somebody take on the potential risk? I would do it because I believe interest rates are going down, I'm selling the house, or I'm going to pay off the house. I don't want to pay that premium for the 30-year fix because I'm not keeping the loan for 30. The Real Estate Show with Pat Lopez, where we talk everything real estate. For this show, I'm going to talk about adjustable rate mortgages, or ARMs. Why am I going to talk about ARMs? Because the MBA, the Mortgage Banker Association, came out with a study looking at ARMs and how they are gaining in popularity. Right now, about 9% of all loans are being done as an ARM, an adjustable rate mortgage. Now, if we turn around and look at 2020 and 2021, it was less than 1%. So I'm going to go over what is an ARM, why do an ARM, and how do they work? So the first thing is, what is an ARM? An ARM is an adjustable rate mortgage, meaning that you get a fixed period of time where you would have a fixed period of 5 years, 7 years, 10 years. Then after that, the interest rate could go up or down. Your payment is still based on a 30-year payout, but once again, you only have a fixed period of 5 years, 7 years, or 10 years, okay? Whereas if you do a 30-year fix, you know your payment is fixed for 30 years. Now, what is the component of an ARM? There's two pieces to an ARM. There is the index, which is the variable portion or the adjustable portion of it, and then there is the margin. The margin is the fixed portion, and I like to say the margin is the profit for the bank. So if a bank turns around and has a 1% or a 2% margin, that would be fixed for the entirety of the 30 years. Now, what can move up and down would be the index. And what are some indexes that we have? You have the prime rate, or the federal funds rate, okay? That is tied to car payments generally, also tied to credit cards. And for people who have homes, your HELOCs, your second loans on your homes, your HELOCs where you're able to borrow money out, that is tied to the prime rate. Prime right now is set by the Federal Reserve. They use the prime rate for the Federal Reserve, which is 4.25, 4.5, plus 3, which gives you that 7.25 to 7.5. So if you're going out there looking for a home equity loan, a HELOC, you're going to be looking at an interest rate somewhere in the 7s. Depending on credit scores, it could be the prime minus 1, prime minus a half, prime plus 1, that kind of thing. So that's something that, most people know about. But on a loan, on a first for your house, there are other indexes that are used, like the SOFR index. And the SOFR index is the Secured Overnight Financed Rate. Okay, that is the SOFR index. So that index can move up and down. So right now, the SOFR index is right around the 4.25. So if you were doing an adjustable rate loan and the margin, remember the margin is the profit for the bank, right? And the index, the SOFR index, is 4.25, your interest rate would be 5.25. And yes, that's what people are doing. They're opting to do a 5.25, 5.5, 5.75, as opposed to having their interest rates in the upper 6s or maybe 7%. That's why they're starting to gain in popularity, because the interest rates are a little bit lower, and that's a way to hedge. Now, why would somebody take on the potential risk? Because when you have an adjustable rate mortgage, that interest rate could go up and down after the fixed period of time. So now, the fixed period of time, before I get into why do an adjustable rate mortgage, you could have the 5-year, 7-year, or 10-year. That means just the fixed portion of it would be for 5 years, 7, or 10. Now, why would I do an adjustable rate mortgage? I would do it because I believe interest rates are going down, or I'm selling the house, or I'm going to pay off the house, okay? In other words, I am not keeping the loan for beyond the fixed period, and I don't want to pay that premium for the 30-year fix because I'm not keeping the loan for 30 years. Let me give you some examples, some things that I've done with ARMs. Example one. I had a gentleman who was retiring. He's 60 years old. So he was downsizing from a big house, but he was buying this rancher with all the bells and whistles. Actually, it was more money than the house he was downsizing from. And he was going to retire in the next 5 years. So he sat down with his financial planner and they turned around and said, listen, an ARM could be a good deal for you because now you're going to save money because you're going to have a lower interest rate, and you're either going to refinance your loan in the next 5 years, or when you retire, because you have this profit sharing money, a large chunk of money he was going to get, he would pay off the loan. So he's either going to refinance if interest rates drop low enough, or he was just going to pay the loan off. So in that example, he's not keeping his loan. So he took a 5-year fixed loan, and with that, he was paying it off, saving over $500 a month, which is $6,000 a year. So $6,000 times the 5 years, he was going to save $30,000 by doing the adjustable rate mortgage. Now, I also had another woman who told me, Pat, I've been in 4 different houses over the past 30 years. I've never been in a house more than 10 years. And she was buying her 5th house, right? So for her, we put her into a 10-year fixed program or a 10-year ARM because she's never been in a house for more than 10 years. So why pay a premium for that 30 years? And that was the logic that she was looking at. And once again, she's saving a ton of money as well over that duration. Why pay a premium for 30 years? I also had another woman who turned around and just flat out believes, hey, I believe interest rates are going to come down, so I'm going to refinance anyway. She bought a home, a vacation home, down one of the beach spots in New Jersey, and she paid $1.5 million for this house. She put $500,000 down, so she was getting $1 million loan. She was going to save over $900 a month, over $10,000 a year she was saving on this, and she ended up doing a 7-year ARM, or 7-year fixed period, on it. And she believed interest rates were going to come down. So she turns around and said, listen, if interest rates take 5 years to come down, I'll refinance at that point. And she was going to save over $50,000. So why do an ARM? The ARM, once again, I am not keeping the loan for 30 years, so I don't want to pay a premium. You do have to understand the risk. Nobody has a crystal ball. So we don't know if rates are going to come down in the future. They may stay high forever. Nobody knows. The likelihood of that happening, very slim. Rates go up, they go down. It's just the way things are. It's just the market, how things work. So, ARM, I don't plan on keeping a loan, and you have to have the risk tolerance because some people just can't sleep at night. They just don't feel comfortable. There's no way I'm going to do it. I'll be tossing and turning. Then it's not right for you. It's got to be right for you, and you have to believe that you're going to get out of the loan in 5 years, 7 years, 10 years, whatever fixed term you do. Also, builders are using buy downs and an ARMs to sell their homes because they can see where by offering interest rates in the 4s and the 5s, they're able to move a lot more product because for them, homes are product. It's a commodity. It's not, hey, I'm selling my house. It's personal to me. For the builders, it's just moving product, period. So they've been doing it, and they're selling millions of homes a year, so it's working for them. We know interest rates really move the needle. So I hope you get an understanding on how ARMs work, why you would do it, what are the motivations behind it. If you have any questions, be sure reach out to me, Pat Lopez, 267-800-2132, 267-800-2132. You can turn around and shoot out a comment saying, hey, you want more information on these ARMs? It is a tremendous opportunity for some people, but it is not right for all people. Okay, so that's the Real Estate Show with Pat Lopez. Hope you enjoyed it. Be sure to follow the show on Facebook and Instagram, and be sure to subscribe. My goal is to hit 30,000 subscribers. I'm over 20,000. My goal is 30,000 subscribers. Really help me out. Also, do some likes. That really helps the algorithm. So do that, and be sure to leave a comment. Tell me some show topics you'd like me to cover in the future. Hope you enjoyed the show once again, and I'll see you next week.